Hello everyone and a very warm welcome to today's major markets update for Friday, February the 7th, 2025. We have the same slide as the previous webcast. The forecast is namely still on track. We believe that the stock market is currently in this smaller wave 5 of a larger third wave, potentially already in a smaller wave 5 of a much larger fifth wave. However, if we look across different indexes, this larger third wave seems to make most sense. We'll see a pretty decent correction for this fourth wave before we see the final fifth wave of this bull market that started at the COVID lows in March 2020. So before we go to the charts, please remember we can never be right all the time. However, as we showed in the slide, our forecast has been pretty nicely on track. This is what we shared with our premium members yesterday. We said if we get a pullback, expect a retrace for the Nasdaq 100 to about 21,200 to 300, somewhere around there. And so this is what we saw, and this is how it went. So far, so good. We did get a little bit of a spike higher, but not by much. All right, that was just about 100 points higher on 21,000. That is nothing, and we got a steep decline so far. So this forecast is still on track. So I do want to point out, of course, that we have here this potential wave 3, and here the potential wave 4. That is the January 13th low. And then we should now be in a larger fifth wave going higher to the ideal target zone of around 22,800 or 24,000. Okay, so this is the path we're looking for. And this was the down arrow we forecasted yesterday. So far, so good. And we should now be bottoming it out for this wave 2, contingent on holding, of course, above Monday's low at around 21,008. And of course, the ultimate line in the sand for the bulls is here at 20,524. Note that is also the same low as we had just after the presidential elections when we gapped open on the news that Donald Trump had been elected. Okay, so this is really, I would say, the bottom line in the sand for the market. If we go below that level, worse things are going to happen. But for now, we're trending nicely higher. That breakout held, and we should now be in this gray wave 2. This gray wave 2 should, of course, subdivide into a wave, a B wave, and a C wave. It doesn't have to, but it should. So we've almost already reached the 50% retrace at around 21,450, but we can easily go to as low as 21,200 for this potential wave 2. All right, this still has potential. It is not set in stone because we have not made a good bullish sequence. So far, we're still pretty much going sideways. We are where we were in early December. Okay. However, besides all the bad news, we're still going sideways. So this is our preferred wave count, contingent on holding at least above the February 3rd low and especially the January 13th low. So we have well-defined risk reward. So if we would desire to buy, of course, in this zone here for this wave 2, then this is our risk. Okay, there is no risk. Depending on your time frame, you either have about 200 to 400 points of risk, or maybe a little more like 1,000, with of course a lot more upside reward. The reward is then, of course, thousands of points. So let's say you buy here at 21,200. This is not a recommendation. This is just pointing out the potential. We can go then all the way here to 24,000. Okay, so you have 3,000 points upside, and you have about 1,000 points downside risk. There's never no risk because that's life. Life is always full of risk. If you make a cup of coffee, you have the risk it will not be a good cup of coffee. Okay, most likely it will be a good cup of coffee, but it could be a bad cup of coffee. For many reasons, the water is not hot enough, or it's too hot, the beans are old, or the machine is not working properly. There are many variables that go into play to making a cup of coffee. So if your cup of coffee can't even be without risk, why do we think the market should be without risk? This is our preferred wave count. We should go a little bit lower, but not necessarily. We've just closed below the first warning level for the bulls. That's it. We're not even touching the second warning level, let alone, of course, Monday's low. Okay? Some people might say, well, we're starting to make lower lows, lower highs. Well, not really. Today's high was above that of last Friday's high. Okay, so far we're repeating the same pattern. A big yank down at the open on Monday, and then all of the week we rally. All right? We rally. So far, so good. So far, so good. This is our preferred path going forward. Now, we can do the same for the S&P 500. Yesterday we showed for the S&P 500 this potential wave 1 high here, and then a wave 2 pullback, and after that, of course, a wave 3, but that's not on the chart because we haven't even seen a pullback to confirm this wave 2. What did we get? So that's how we saw it, and this is what we got, a pullback, a very nice pullback, and of course slightly higher prices so we can raise the wave 2 target zone. Note, just as for the Nasdaq 100, we're getting quite oversold, but I have no signs that we have reversed. So oversold every single time is a good indicator of low risk entries, okay, on the hourly time frame. But we have no signs of a bottom being in place. If anything, we'll probably go for an A wave here, a B wave, and then a C wave. That's the preferred path. It doesn't have to be that way. I also want to point out that we can count 5 waves up here for a what I would count as a leading diagonal wave 1 in gray. Okay, 1, 2, 3, 4, 5, and they're non-overlapping. You can see 1 and 4 don't overlap. 3 is not the shortest wave, so this is a pretty valid leading diagonal. Wave 1 subdivided, wave 3 subdivided, and wave 5 was just straight up. If we zoom out to the daily chart, this is what we shared with our premium members yesterday as well. We're right here at the upper end of the target zone, and this little down arrow that we forecasted yesterday is now in effect. Okay, so contingent on holding above Monday's low, which is at about 59.23, we expect the market to bottom out in this target zone at around, I would say, 5,900 plus or minus 100, and then rally to the upside target of around 62.85. Pullback, and then another rally. So then, once we've completed green 3C, we let the market decide if all of 4 or 5 / alternatively bigger third wave has completed or not. Because if this is a ending diagonal, we should most likely expect only 5 waves up and not of 3 waves up and not 5. So this covered both the Nasdaq 100 and the S&P 500, and so far the market continues to follow our forecast. Better said, our forecast is still able to predict what the market will do quite accurately, so we continue to hold this bullish stance that we've had and don't get sidetracked by a down day and panic. Okay, again, we're look at this in a long-term uptrend. This is not a downtrend, a long-term uptrend. Look where the 200-day moving average is in relationship to the price. The 200-day is rising. Okay, where are we in relationship to the 50-day? We're above it and it's rising. The only thing we're below is the 10-day simple moving average, but that's short-term. We're also above the 20-day. The 20-day is now also above the 50-day. So this chart is now almost 80% bullish, where you say all the variables, are they bullish or bearish? Well, we're above the 200-day, that's 1. Above the 50-day, that's 2. Above the 20-day, that's 3. All of them are rising, that's 4. Cloud, that's 5. And we're only below the 10-day simple moving average. So 5 out of 6 are bullish. Thus, we must remain bullish. Same for the Nasdaq 100 daily chart. Where are we in relationship to these variables? Let's assess. This is the 200-day moving average, rising, and it's below that one is below the 20-day, it's rising, and price is still above the Ichimoku cloud, it's rising. Moreover, to reiterate, we're also, of course, here in a long-term uptrend channel. So we have, again, and actually right at the 10-day, 6 out of 6 variables are bullish. So we must hold a bullish view until proven otherwise, with the first line in the sand for the bulls 21,008. Very simple, all right? Price is the final arbiter and not some analyst on some obscure website that has an opinion. Price is the final arbiter. All right, then we look here at the regular NASDAQ. It's been choppy, to say the very least. Not what I like. I don't like choppiness. Who likes choppiness? Some people thrive in choppy environment because they like to trade quick. I don't, but this is still a potential for a larger fourth wave for the NASDAQ, okay? That's not to be means that it's going to be the same for the S&P 500 or NASDAQ 100. We did close a little bit below this uptrend line. Okay, it's a little arbitrary on how exactly you want to draw this uptrend line. Should this line here, for example, touch there and then there, and this would move then this line a little bit lower? Yeah, to be determined. But for now, this is our alternative. This is our insurance premium. Or insurance policy. Not yet, we haven't got any premium. And that this larger fourth wave is still underway, and after 4 still comes 5, because since the August low, as you can see here, we cannot count 5 waves up. 1, 2, 3, 4, even if it becomes protracted, and then 5. Some people will count this as wave 4, but it doesn't really fit within this Elliott wave trend channel. It's not uncommon for a fourth wave to go a little bit below the trend channel. Similarly, it's not uncommon for a third wave to go a little bit above the trend channel. And I'll show you how that works. So we can adjust, of course, the trend channel a little bit, as you can see here, and we're just going to go like this, okay? Something like that. It's a little bit arbitrary, of course, how exactly you're going to draw that trend line. Is it touching there, or is it touching there? However, we did break out above this trend line, and we're still holding. Regardless, even if we go here to 18,800, we still believe that a larger fifth wave is yet to commence. This is our preferred wave count. The chopping around is just all ABCs, ABCs, and this green C wave should soon transpire. Contingent on holding once again above the January 13th low. We go below that low, this wave count is invalidated. That's all we can do. Okay, we're just pointing out the potentials, and unfortunately sideways markets are not the easiest to interpret, but that's why we go by price levels. How about the Dow Jones? Well, on Monday we thought that could all be of this green 2/B. However, we preferred the ABC. With today's price action, I think that becomes a little bit more likely. So we're going to move the label here, and we'll place an A wave low at Monday's low, a B wave high at yesterday's high, and now a wave C underway. Okay, this could, by the way, morph into a flat. So somewhere around this price level is where we're going to look for the wave 2 low. All right, after 2 comes 3, and then 4 and 5. And this should then still complete a larger third wave. Allow me to show that using, let's see here, the bigger picture chart for the Dow Jones. And I will use, I believe, the weekly chart, maybe the monthly chart. Not this one, not this one. So I'll have to go through the monthly chart there. So we should be in this A, B, C for 5 of 3, 4, 5. Okay, this is our preferred bigger picture wave count. Also here, look where we are in the bigger picture. We are above the rising 200 month, 50 month, 10 month, 20 month, all of them are rising. If I should add the Ichimoku cloud, we'll get a 100% bullish chart. Okay, everything is rising. We're in the trend channel. 1, we're above the 10 month, 2, 20 month, 3, 50 month, 4, 200-day moving average, 5, Ichimoku cloud, 6 out of 6 are bullish, so we must remain bullish on this index. So we believe this /B is underway, and then a 3C into the 48,000s, potentially as high as 52,000, depending on if we get 5 waves up or only 3 waves up. Again, all contingent on holding above the January 13 low. Okay, with a serious warning, of course, if we go below 42,500 for the Dow Jones. IWM is nicely working as well. This is our ideal preferred wave count. This wave 2 should be underway. Hasn't changed. We said anywhere between 224 to 227. So far, so good. And a breakout above Thursday's high, which is of course the previous week high and the week before that high, will then trigger wave 3. And we get a 4 and a 5. And as you can see with this setup here, we can target exactly the 161.8% extension right at about 246. Pullback to about 236, and then a 5-1 relationship targets the bigger picture 253 level for the IWM for this wave 3. Third waves tend to target the 161.8% extension. Okay, and then we'll get a pretty big pullback. That would then be a larger fourth wave and a larger fifth wave. That would then also again match with what we saw for the Dow Jones. Larger third wave, fourth wave, fifth wave. All right, so we've covered all the indexes. Let's go to Market Brev. What did we get for the bullish percent index today? It actually closed a little bit higher for the Nasdaq. That's interesting. More charts became bullish for the Nasdaq. How about for the S&P 500? Also, this one is still increasing. It increased today, even on a down day. That's bullish. All right, down day, still more stocks are advancing than declining. How about the AD line? Let's do a detailed study of the AD line. You can see between January 21st and earlier this week, we have an increasing AD line. Okay, price in the meantime remained flat. So oftentimes, Brev leads the market. You can see that here between yesterday and the day before, we had slight negative divergence. Yesterday, we made a higher high, but the day before, we actually had a higher AD line. So on a higher high, less stocks were advancing than the previous day. And so today's decline is not really a surprise. But please remember, from the bigger picture, we need months to years of negative divergence on the cumulative AD line to tell us that a bear market is underway. So anybody who is already forecasting a bear market at this moment is really ahead of the game and probably timing wise off by many, many months. And that is, of course, not very tradable and falls within the even a broken clock is twice right a day. All right, so far, no negative divergence on the bigger picture. We need to see negative divergence on the bigger picture months to years to tell us that a larger bull market is underway. This doesn't preclude like crashes as COVID, 2022, 2010 and 11 and 15. Those can still happen, but we need to see months-long negative divergence. We didn't see that negative divergence during those strong corrections. How we're doing on the McClellan oscillator? It's currently negative, so more stocks were declining than advancing. That means the summation index is starting to turn down, but it's still on a buy. How we're doing on our longer-term indicator? It's still positive. All right, the solid line is still above the dotted line, so this is still a uptrend. So today should be considered a down move within a longer uptrend. That's simply the price data we have. Last but not least, sentiment is not the most reliable of indicators, but what are active money managers saying? They're about 85% exposed to the market, a little bit above average, but nothing too crazy. And again, even overexposed does not mean that we are instantly going to top. How are mom and pops doing? The AAII Investor Sentiment Survey. So these are more individual traders and investors, not institutions. On Thursday, data was released and 43% of individual investors are bearish. That's quite a high number and suggests that too many people are bearish on the market. And most of the time it means that individual investors on the wrong side of the trade. Last but not least, the Fear Greed Index is back into fear. It was fear last week, back again into fear. Most of the time, that is a good time to buy. But again, price is the final arbiter. We have not seen any reversal just yet. So overall, markets are following our forecasted price action reasonably well, if not pretty well. So we keep a bullish view on the market, contingent on holding at least above the February 3rd low and especially the January 13th low. Everything else is still on track, and we wish you a great weekend, and we'll catch you all later next week.